Well, to get an in-depth view of how the market's trading today and what he is looking at, what's catching his eye, I'm joined by Wilhem Hertzog from RECM, who is in our Cape Town studio. Good afternoon to you, Wilhem. Let's start with the oil price. I haven't heard your comments on it yet. It does seem to have stabilized now in the late 40s, although it did seem to be in free fall last week. So how are you thinking about the oil price? And perhaps by the way of that discussion, you can get us onto how you're thinking about Sasol.
I think the oil price move and the quantum thereof has probably caught most people by surprise, including us. We certainly didn't expect such a massive move in such a heavily traded, important commodity in such a short period of time. And I think what's even more interesting about oil, as opposed to many other commodities like steel and iron ore and those related to infrastructure build, is that oil is a commodity which is consumed on a daily basis. It's not something which you can really store 2 or 5 years of supply worth of and then stop consuming or stop buying fresh oil for 2 or 5 years or however long it takes. That's something you can do with steel, and you can stockpile things like gold, etc. You can't really do that with oil. So the demand picture for oil is typically very stable, and that has been the case for most of the past number of years. And the slump in demand that we see this year, potentially coming out of Europe and China slowing down, etc., is really very small in the context of the greater global oil market. So this massive price response to such small changes in demand, and I guess smallish changes in supply, with the market seemingly being somewhat oversupplied. But the dramatic price move really is a bit overdone in our opinion. Now, whether the high 40s is now the level for the next year or two, certainly we have no idea. But we do think that based on what the marginal cost of extraction is of the number of barrels of oil that the world needs on a daily basis and on an ongoing basis, we think the current price is too low to incentivize producers to produce that amount of oil, and hence the price won't stay here forever. But as I say, we've got no way of really forecasting how long the price could stay at depressed levels. One never knows how long sentiment stays negative and how long momentum carries on in one direction before something equally unforeseen triggers a turning point again.
Well, I suppose if we did, we would be making a lot more money than we do, although some of us, maybe you, are making a lot of money anyway. But what also strikes me about the oil business, Wilhem, is that it's an unusual market in the sense that for the first time in probably a generation, 30, 40 years, there actually is a market operating now. There's an oversupply given global demand, and the producers are certainly not pulling back to manipulate that supply. They're going for market share. So it's kind of a genuine market with the price falling, and there will come a point where those producers find that they can't produce at that level, or some of them won't, and the price will stabilize and go up. And yet at other times, the oil market is a highly manipulated market, turned on, turned off, sometimes politically, sometimes for other reasons. So it's a bit difficult to think about this market. It's not like a retail market or a car sales market where it really is supply and demand all the time.
Sure, that's very true. And OPEC obviously has historically supported the price and has now decided not to do so to the extent that it has historically. But I do think even within OPEC, there are higher cost and lower cost producers, and the higher cost producers within OPEC cannot withstand the current oil price indefinitely. So at some point they will, if the current price prevails and if it is on account of OPEC keeping the market oversupplied, I do think that at some point there will be some capitulation of members within OPEC, which will then again imply that the market power of the cartel is reduced, and potentially we see a more normal market going forward in oil with more, what shall I say, market-driven supply and demand picture like we're seeing today.
Wilhem, let's look at Sasol. I find it fascinating the way people talk about Sasol. On the one hand, it seems quite simple. The Sasol price goes down when the oil price goes down. And there's been talk this morning in the newspapers about their dividend dropping. So it depends how you look at Sasol. Is it a dividend play? Is it a long-term play? And what kind of bet you're taking on their fracking expedition in the US? Other resources companies pulling back on capex, they can hardly pull back on this now, can they?
Sure, it is quite late in the day, especially for the ethane cracker, and it is a long process which has led up to its approval, and the capex is starting to flow. So it is difficult to pull back on it now, and it would be a a fairly material loss of face if they do so. But I do think we have seen, what shall I say, projects being mothballed and put on ice in past commodity downturns. I think we saw plenty of that in 2008, 2009, where some fairly major capex investments by mining companies were put on hold, and then sometimes were never brought back to life again when prices recovered, because demand subsequently was just never strong enough to support those projects. So it's not totally impossible that they pull back on these projects. And certainly at current oil prices, the economics of those projects they have in the US are dramatically different to what they were at $80, $90, $100 a barrel. And when one would think if current oil prices prevail, there's little chance of Sasol earning its cost of capital on the capex spend they are engaging in, because it is a major chunk of capex they are putting to work there, and they need to be fairly sure that they make their cost of capital. Otherwise, it'll just be a perpetual black hole dragging down returns for the group as a whole.
Okay, let's pause, or rather end our conversation on Sasol and the oil price. I do find it fascinating, and the oil price has certainly caused a lot of excitement, some of it unexpected, of course. I just want us to pause our discussion now, Wilhem. You can hear and watch him in Cape Town. We have Oliver Blanchard, who is the economic counsellor at the IMF, talking about that reduction in the growth forecast for the world, essentially, and also part of that was South Africa. So let's have a listen to that, and we can talk about the likely effect on our own growth prospects and therefore on the companies that you watch. So let's hear what he had to say.
The medium run, the future doesn't look as bright. Investment is weak, and so for most countries, we're revising down. Not much, but down. Now, this being said, I think we may be a bit pessimistic about the effects of the price of oil. So in the jargon of economists, there's an upside risk, which in fact, the price of oil will help more, and things will turn out better, but we can't count on it. In general, I think emerging market countries face two challenges. The first one is this one, which is high interest rates in the US, which are going to force them to have high interest rates in general. They are going to have tighter financial conditions. To a large extent, I think this is anticipated. This is already built in interest rates, in exchange rates. So this may not be as bad as some think. The other challenge is an internal challenge, which is that many countries are facing a decrease in potential growth, and they have to decide what to do about it. Policymakers in China have decided to reduce some of the dangers that they were facing on housing, on shadow banking, are taking the right measures. They're also trying to reorient growth from investment to consumption. So all this is desirable, but it's leading to a lower growth rate. Our forecast is only of 6.8% for 2015, which is lower than what it was in 2014. Now, this is having an effect on the rest of the world, food trade. So Asian countries around China will have, other things equal, lower growth because they will be exporting less. We think the effect is relatively small. If you wanted a number, 1% less growth in China leads to about 0.3% less growth in Asia. It will have a small effect on the rest of the world through trade. The other channel is through commodities, which is that lower growth in China means lower commodity prices, and this is affecting countries in Latin America, which have been facing now for some time and will continue to face lower commodity prices. That's a challenge for them.
That was Oliver Blanchard from the IMF, Wilhem. Just picking up the points he made at the end there about Chinese growth, expecting it to be 6.8% for 2015 to 2016. And that point about a 1% drop in Chinese growth, 0.3% in Asia, but less elsewhere. But of course, the effect on commodities and perceptions of commodities. Now, let's talk about that range of commodities. And I think the point you want to make is that it's not the same for all of them.
Sure, absolutely. I think the impact of slower growth in China, as is now being forecast, is different on different commodities. So one immediately thinks that commodities like steel and steel-making raw materials, i.e. iron ore, metallurgical coal, the impact on demand of a material slowdown in China will be much more severe in those commodities than there will be for commodities like gold or oil, or even platinum, where China is not as material a consumer of global supply as it is for, say, iron ore and some of the coal complex and maybe even copper and those metals. So definitely one shouldn't just have a knee-jerk reaction of thinking that China is slowing down, hence avoid all commodities. I think there's definitely, one needs to focus on the underlying supply and demand fundamentals of each commodity individually and make up your mind as to whether those supply and demand fundamentals are accurately reflected in the current commodity price or not. And obviously that assessment has a material or knock-on effect on one's view of many of the metals miners and companies in the broader mining sector.
Now, you've quite liked platinum as an investment case in the last year or two. The Northam company, they've had a strike this week, and it's at the mine which produces some 2/3 of their production. It just doesn't look like it's going to be too serious, although it has been a week now that they've been on strike. But it reminds us of the effects of that long strike last year, the 5 months, the violence, and the huge impact there on the platinum market. So where is platinum now for you?
For us, platinum is still looking very attractive. The long-term fundamentals of platinum in terms of supply and demand are still very attractive. South Africa still controls the vast majority of global supply and of reserves and resources. And the demand picture is solid and growing globally. Stricter environmental regulations, increased automotive vehicle ownership in countries like China, etc., even despite slower growth, all those things bode well for the long-term demand picture for platinum. At current prices, it's quite clear that the entire industry is making basically no money. And if current prices persist, then supply will continue to be cut. We've already seen a number of announcements of expansion projects being curtailed and mines being either mothballed temporarily or being sold off, etc. These are all symptoms of a market where the underlying commodity price is too low or unsustainably low. So we're very optimistic of the fact that in the longer term, the platinum price will reflect a more realistic price to incentivize the appropriate level of production for global demand. And that price, to our minds, is closer to the $1,900 or $1,800 per ounce level than to the current sort of $1,300 per ounce level that we're seeing.
Yeah. We had one of those funny days the other day when the gold price and the platinum price were exactly the same. Let's just move finally, Wilhem, to the update from AstraPac, operational update. I think of interest not just for that company, but a reflection of conditions in the manufacturing sector, because they supply other manufacturers and producers. Also dependent on electricity and that integrity of supply, no interruptions to electricity supply.
Yes, I think that trading update's a pretty solid reflection of the overall economic environment in South Africa. And I guess one could almost summarize it as being sluggish, with lots of impediments to growth, being blackouts, etc. Our clients are substantial shareholders of AstraPac, so we quite like the business, and we quite like what management has been doing there. The management team there was brought in to really sort out a bit of a mess which had fallen apart after a conglomerate was built up through various acquisitions which didn't always necessarily have the greatest fit. And the current management team, we think, have done a very good job of clearing the deck, focusing on the core issues and getting the business back on a solid operational footing and focusing on the strengths of the business. And that does seem to be bearing fruit. We see they've strengthened the balance sheet nicely. So all in all, I'd say the business is on the right track. Not there yet in terms of where it should be operationally and profitability-wise, but we think management is doing all the right things and it'll get there eventually.
Good place to end. That's Wilhem Hertzog. He is from RECM.